back, guys. Thanks for hanging on with us. You're listening to Benzinga's Pre-Market Prep. I'm Brianna Valesky here with Joel Elconin. We're joined by Stephen L. Weiss. He's the Managing Director and Chief Investment Officer for Short Hills Capital Partners. A 25-year veteran of Wall Street, Stephen has held senior management positions at Salomon Brothers, SAC Capital, and Lehman Brothers, where he built Wall Street's #1 ranked sales force, in addition to co-founding a hedge fund. Stephen, thanks so much for joining us today. We really appreciate it.
My pleasure. Thanks for having me.
So we have to start with the Fed statement from this week. Before, you on CNBC, you had said investors are ready for the rate hike. They removed patient from its statement. Do you think we're going to see a rate hike this year?
I think we will, but likely at the end of the year. The big issue is inflation, of course. Mm-hmm. And I also think what the Fed's keeping an eye on is the labor participation rate. But let's assume they go with labor, jobs increasing, eventually wages increasing. They've got to focus on inflation. Right now it's deflation. And that's part of the dual mandate. That happens to be the only mandate in Europe, and we can see how aggressive that Draghi has recently become, overdue might I add, in terms of their quantitative easing. So bring that issue over here, and you can see why the Fed has taken patience out, because it was a freebie. It was given to them. Every commentator in the market, maybe except one, but 95% of them were saying it's coming out. So when it's that well disseminated, it's a freebie for the Fed. So take it out, because the market's not going to react to it. And then go ahead and continue with your thought process, if you're yelling, that we're going to be dovish until we get a better grip on inflation and see some improvement, because you can't grow an economy without some price increases. So I think it comes. I don't know that it comes in September. It may be later, but it really doesn't matter, because the market is ready for it. And if you look at any chart, and I've run all the data, markets continue to rise when rates go up. And that's from prior cycles where we were starting at a much higher rate, a much higher Fed funds rate than we're starting at now, which is virtually zero. So maybe there's a knee-jerk reaction when it actually does happen, but if you go back to what everybody thought was a cataclysmic event, which was the U.S. debt being downgraded, a nice rally ensued. So with the market being such a great discounting mechanism, more so now than ever in my career because of all the information flow, I think the market continues to rise.
You're absolutely right about every market commentator just focusing on this word patient. I mean, do you think everyone's just too hung up on every single word that the Fed says?
Yeah, and what we do at Short Hills Capital is that we invest in hedge funds, and I can tell you that not one long-short equity manager that we invest in pays any attention to Fed language or I wouldn't say pay any attention. I'd say it's not really an input into their work. It's strictly bottoms-up analysis. If you want to look at a macro indicator or a market indicator, the most important one to look at this time is the equity risk premium. And very simply, without getting too geeky or wonky, what that is what you're paid to take risk in the equity market. And you want it to be high. And right now in Germany, it's among the highest level it's been. In the U.S., it's high. In Japan, it's high. And what that means is that you're comparing it to the risk-free rate, which is the rate you get in bonds. And with a 10-year bond yielding 20 basis points, 22 basis points in Germany, you're going to see more money go into equities. And you'll see it in the U.S. too.
We're on the line with Stephen L. Weiss. He's the Managing Director and CIO for Short Hills Capital Partners. Stephen, I want to talk a little bit about hedge funds, and that's a big element of your business, analyzing hedge funds. Tell us, what are some of the key elements that you look at when you're analyzing hedge funds?
Well, we look at performance, but it's been difficult to discern performance over the last couple of years. In 13 particularly, I don't want to sound trite, but if you showed up for work and you didn't do anything very stupid, you had great performance, because the market was up 32, and great performance for a hedge fund was 20 to 24%. Now some, like Dave Tepper, did phenomenally well, putting up in the 40s. But I'd say a good hedge fund put up in the 20s. And hedge funds aren't supposed to beat the S&P because they run a hedge strategy. So one of the things I look at is performance, but within the performance, the primary focus for me is drawdowns. That means losses. Because if you're running a hedge strategy, and if you're not going to put up S&P numbers in a rip-roaring market, you better protect capital in down markets. So if you turn that to 2014, well, we worked the hardest in October, because there we got to see how managers reacted. Did they run scared as the market was trading down to October 15th, or did they stick to their guns and even rely on their fundamentals and take the opportunity to buy an American Airlines at $29 because of Ebola scares, which wasn't going to put the airline out of business? So one of the things we focus on are drawdowns. The other thing we focus on is style drift. So we actually redeemed from one manager who made a lot of money in Gilead. And we told them that's why we're redeeming. They said, well, that's ridiculous. Other investors have congratulated us. And I said, well, that's good for them, but the facts are you don't invest in healthcare. You specifically told us you don't invest in biotech. So style discipline is critical. And the worst thing for a manager is to have success when they drift from their style, because that only emboldens them to go further away from what they know. So we look for a repeatable, disciplined process. We look for smart people. We look for strategies that are scalable. And we just want them really to protect our capital first and foremost. And we also prefer managers that are smaller, because it just makes so much common sense that you can't put up the same types of returns, unless you're David Tepper, of course, and a couple of others like Viking, Andreas Halverson. It's very difficult to put up returns when your asset base gets so large, because just by definition, the opportunities that you're looking at shrink.
Okay, just going on talking about hedging. I mean, how should a smaller investor, really approach hedging? I mean, the way it's been with this market, if you've been buying puts or selling calls, it really hasn't been that profitable. Where do you get to a point, in someone's portfolio where it makes sense to, have some hedge fund money or trying to actively hedge a portfolio?
Well, a hedge fund, in my view, if you're an accredited or qualified investor, and only if you're that, should you have a hedge strat? Should you invest in a hedge fund? You're not able to otherwise. Liquid alternatives, a lot of 40 Act funds. To me, they're at best B- funds, because the really good managers aren't giving you their A product, particularly in equities. Because look at it this way: if they're able to charge 1.5% and 20% incentive, or 2% and 20% incentive, and not provide daily liquidity, which impacts the stocks they can buy, why on earth would they go into a fund and charge only 1%, give complete transparency and daily liquidity? They wouldn't. They're only doing it if they can't raise capital elsewhere. Now, the credit markets are different. So the credit markets, they're much deeper, particularly in the U.S., so maybe they do it. But all investors, it depends on your time horizon. Markets go up way more often than they go down. And shorting stocks is one of the most difficult exercises in the market, and really is only for, in my view, professionals who work in the market every single day. However, for the retail investor, volatility is so cheap that you have to protect your portfolio in some regards. And you can do that through the VIX. You can do it through selling calls or buying deep out of the money puts. And you have to really look at it as insurance. And it's going to cost you money. But it's no different than health insurance or medical insurance. If you don't use it, great, you're happy to have spent the premium. But it's there if you need it. And since volatility, as I mentioned, is so cheap, it's crazy not to take that insurance out. Now, if you have a 10-year time horizon on a stock like Apple, for example, I don't think you really need to hedge Apple. It's going to go down, it's going to go up, but that's not an name you have to hedge. You should hedge your overall portfolio to a certain extent. Again, if your time horizon is 10, 20 years, I wouldn't worry about it that much. But your riskier names, you definitely should be thinking about insurance or hedging.
That's a great point you made about shorting stocks, that it's one of the most difficult things people can do in the market. Speaking of a recent short, what are your thoughts on lumber liquidators right now?
It's unanalyzable, basically. It's a crapshoot either way. It's nothing that I would own on the long side or the short side, because as an investor, I can't analyze it. I have no idea, unless I'm going to go out and physically test their floorboards myself in the factory. How do I know? So how does anybody know? But what I do know is that the brand is damaged, that if you take a look at other instances of damage to brands, just look at what happened with Yum in China, tainted chicken. The Chinese market still hasn't come back completely a few years later. And in what is basically a commodity market, floorboarding, flooring, nobody has to go and take the chance on lumber liquidators. So there's going to be some impairment to their earnings going forward. Is it permanent impairment? I don't know. Maybe they get over it, but it's definitely going to cost them a lot of money, both in lost sales and in terms of, getting the word out and marketing. So I'm not a fan of it. People looking at it and saying, well, this is my favorite thing. Well, a stock came down from 70 to 30, so it's cheaper. Well, in fact, a stock can go from 70 to 30 and be more expensive if the earnings get cut more than in half. So the valuation has gotten worse. So too often, retail investors and professional investors try to catch a falling knife, not realizing that the valuation metrics have changed dramatically. If stock trades from 70 down to 35, for argument's sake, and the earnings stay at $5 a share, then yes, you've got yourself a bargain. But if the earnings go down to $1 a share, you're paying $1. Your PE is now 35, whereas it was 14 before. Is it cheaper because the stock's cut in half? No, it's 4 times more expensive.
Stephen, I'd love to get on some of the individual issues that you're in right now. Last time I saw you on CNBC, one of the ones you mentioned, Wall Street darling, Apple. Can we get your short-term and long-term perspective on Apple right now?
Sure. On Apple, I own the stock. I did own the options going into the announcement, because stocks typically trade up. So I started peeling them off, and frankly, I waited too long. My thesis was that, like the word patience in the Fed statement, that expectations were so low with the iWatch that any news would be good news and they would surprise the upside. That didn't happen, and the expectations remain low, and maybe even gotten a little lower. Nonetheless, Apple it's a leap of faith in some regards, because you really don't know, and any analyst that tells you this is just making it up. I have no idea how many phones they're going to sell. There's no way to know how many phones that they're going to sell each quarter. So what you're betting on is a brand, and you're betting on management. And I'm comfortable making that bet with a stock price in that regard as relatively inexpensive. So to me, you're buying the brand and what the brand can do in the ecosystem. So Apple TV, expectations again are very low on that because it's such a competitive space. But if that becomes part of the ecosystem, it's going to drive the company. And Apple can come out with technology that's not as good as other technology. Like, I'll tell you, for example, I thought the BlackBerry was much easier to use. I mean, who wouldn't rather use a keyboard? And I like their hub system, their messaging system that has all your messages in there. I think it's easy to use. But it's not Apple, so it's going to get hurt. Apple actually suffered from this same affliction early in life. Nobody will tell you that Microsoft is a better operating system than Apple. Apple had the better operating system. Microsoft had the better marketing early on. And that almost put Apple out of business. So Apple now benefits from what Microsoft benefited from. So I'm buying the brand name, which has global reach, which everybody in every other country wants to own. If you've been in an Apple store in Spain, for example, as I have, it's packed. I mean, it's literally like the subway at rush hour in New York City. So it's cheap stock. I do think they'll innovate. I don't think they have to have the most cutting-edge innovation, just a good consumer product.
Stephen, I completely agree with you on the brand. I mean, they've just got this immense amount of brand loyalty, and I've even heard that Apple stores are one of the few things keeping shopping malls alive nowadays. Let's move on to the biotech sector this morning. We've got a ton of names skyrocketing up this morning. Last time I saw you were in Salix. Is that still one that you're looking at?
I am in Salix. I bought Salix before the first bid, and by Valiant, and I thought, you know what, let me hold on to it. I've got a cash bid for 160, even though the stock was trading at a discount to it. Unusual, because in this market they usually trade to a premium in the hopes of another bid. Then Endo came along, and Endo, by the way, is a great buy on its own. And what a lot of people didn't focus on is that the CEO of Endo was J. Michael Pierce's number 2 at both McKinsey and at Valiant.
Oh, wow.
So he's playing from the same playbook.
Yeah.
And what even made it more interesting is he was trying to steal the acquisition from him.
Oh, I didn't realize that.
So it's kind of cool. So I am in Salix. Right now it's an ARB. I've only no other bidders coming out. I've got $2.50 left there, which is a small spread on a $172 stock, but it's better than keeping it in cash. So as long as I'm not fully invested, which I'm not, it's a good place to hold it. Now, I don't know that I'd buy it here, and I think of selling it because M&A can always go away, and then my risk is the stock drops significantly. So I'll likely sell it.
Okay, and then one more you also mentioned to us this morning was Experian. What's your outlook for that one as well?
Yeah, it's been great. I mean, you know, I bought this stock less than a week ago at about $73 a share, and it's traded at 110. Jim Cramer mentioned it yesterday, and it looks like it's going to gap up a little bit. The story with them is that they're going through the trials on a cholesterol-reducing drug that will compete with Lipitor, except it doesn't have the same side effects of Lipitor. Now, interestingly, they announced an offering, and I bought more on the day they announced. They announced an offering on Wednesday of $150 million. I think it was Tuesday night, possibly, of $150 million. Small. But what's good about that is that they're able to fund without giving away significant royalties to a drug company to get the capital. Now, when they announced it, the stock was at, I think, 100. It traded down initially to 95. But as word got out that the books were filled and that the deal was basically way over-indicated for, the stock traded up. And it traded up to about $106. So it will continue to go. The data was pretty strong, and I like it. I mean, I think you can see it up 50 to 100% from here, providing it gets through the next trials. It's not without risk, though.
We've had Stephen L. Weiss on the line. He's a managing director and chief investment officer for Short Hills Capital Partners. Great advice, Stephen. We really appreciate you joining us this morning, and we hope we can have you back sometime soon.
That'd be great. I'd enjoy it.